Okay, last week we look at the bad debt, which I have explained you are the debts when we think that someone will not be able to pay us. So we wait, what is this? Okay, someone will not be able to pay us. So we zeroize the trade receivable and make sure that we open a new account called as bad debt expense and transfer the amount into income statement as an expense, because if someone cannot pay us, that is an expense to us, that is kind of loss to us, that why that person is not paying us, right? Therefore we have something called provision. We make a provision in order to make sure that we are aware of this loss ahead. Okay, so we are aware of this loss ahead in order to make sure there is no sudden change in income statement. Okay, now provision, the first year provision will be fully 5%, but then we record only the increase or decrease throughout the years. Now whether there is an increase or in provision or whether there is a decrease in provision, and this is the journal entry. I told you, you can do it the longer way or you can do it the shorter way, depends on how you understand. These were the question on bad debts, and there was bad debt recovery as well. Bad debt recovery was that you thought someone will not pay you, but then someone paid you. Okay, this is basically the two entries, right? You thought someone will not pay you and then someone paid you. That was the last chapter. Now moving on with the next chapter, capital uh, expenditure and revenue expenditure and receipt. Basically we have capital expenditure, we have revenue expenditure, capital receipt, revenue receipt. Receipt mean income. Okay, capital receipt mean any money that is spent on non-current asset. So that means the money we spend on non-current asset is compulsory. Okay, for example, when we are buying a machine and you pay 500 for delivery, so when you are buying a machine and if you don't spend that 500, you are not going to get that machine. Okay, another example, if you buy a motorbike or motorcycle and you do not pay for insurance, insurance is compulsory, you cannot run away from insurance. Okay, so that those type of expenses are called capital expenses. What are revenue expenses? Revenue expenses are anything benefits the current financial year which is temporary. Okay, that means this amount we see in income statement under expenses. So the expenses we see in income statement are revenue expenses. Okay, so these are temporary and it has to be done frequently. What does that mean by frequently? For example, renting the shop. If we are renting the shop, it is done frequently, right? We pay the rent every month. We pay the rent every month, so that expense will go in income statement. Let's say we service our motor vehicle or motor car or motorcycle every month. That is not capital expenditure, that is revenue expenditure. But let's say our motor vehicle break down or get damages, that it is not working. If it's not working and we have to spend money on it, then it is called capital expenditure. So this money that we spend on non-current asset is necessary. So if it break down, it means it's not working. That means in order to make sure it works, we have to spend the money, and that money is compulsory, right? But the service we do every month is not compulsory. Even if you don't do the service for the bike, it's still working. Okay, it's just to make sure the bike is clean or increase the productivity of the item. Now what is capital receipt? Capital receipt is the money received that is for long term benefit to the business. What is revenue receipt? That is something that benefit business in short term. For example, sales that we see in income statement. Okay, for example, sales we see in income statement, short term benefit. Discount received, okay, all those incomes in income statement you see are revenue receipt. Now let's come back to this. Money received that is for long term benefit, right? For example, it can be a loan, okay, which we are going to use and invest in something, or may not use in a long term, okay, but we have received this money which will help us in a long term. Okay, now we also can receive from many other resources. So anything we are receiving that will help us in long term benefit is called capital receipt. Pretty straightforward, nothing complicated. Just do question 7 and 8, then we can move on with next chapter. I'll see you on Sunday. Okay.